All right, so as usual, appreciate those that are here. I try to run these like a crowdsourced live podcast, so please do me a favor. Don't be shy. Feel free to come up, click on that bottom left mic request button. Happy to engage you as we have this back and forth conversation with a man who is extremely busy, and I can certainly relate to that given the number of interests that he's got. This will be on all of your favorite platforms, Spotify, Amazon, all that good stuff under that Lead Lag Live banner. With all that said, my name is Michael Gagliardi, publisher of the Lead Lag Report. Joining me for the hour is Max Gagliardi, who has been kind to me in the past. He had me on his own podcast, sent me some very encouraging words. So I'm glad we get to connect in this kind of forum here, Max. For those who are not familiar with your background, talk about who you are, how'd you get involved, interested in the energy space, and why in the world are you doing so many different things?
Well, Michael, thank you for having me on, and I appreciate the chance to be here. Yeah, my name is Max Gagliardi. My primary role is the co-founder of a company called Ancova, that's ANCOVA, and we really work with a lot of small and kind of mid-sized oil and gas producers, mostly here in the U.S., and the easiest way to put it is we help them with their product sales. So everything from like negotiating their midstream or infrastructure contracts to actually physically brokering the sale of the products. We've got our Ancova Energy Marketing Company, which takes physical title to natural gas. With oil, we primarily act as agent. But really what got us into doing this was that, out of college, started working for Chesapeake Energy and had interned at some other midstream entities before that. And at the time, it was the largest natural gas producer, or the second largest producer and the most active driller in the U.S. And so I just got really lucky early in my career to be able to get put into a position where we're at this company that was just blowing and going, spending tons of money. It ended up being on the precipice of having some troubles. But when I first got there, it was really kind of the heyday of the shale revolution, and just got put in a position that I felt was the most interesting to me, which is how the money is made, basically. So you've got all the technical professions in oil and gas, the people drilling it, and there's all the science and engineering involved. And then you get the well done and you put it onto production, and then you have to sell the product. And that's how, the money comes in. And the role that I was in was called like a commercial representative. And so basically the person that was kind of the liaison between the drilling company and the operations people, and then all these in markets. So things like negotiating the gathering agreements to get pipelines to the wells, or scheduling the trucking for oil to come picked up or get picked up. Or sometimes we would do gathering for oil. We also did a lot of large scale infrastructure projects like downhaul transportation pipelines. You remember a lot of these shale basins early on it was just the beginning. So you really didn't have the takeaway that was needed to bring the product from, for example, the Northeast to these other markets that needed it, or from, Texas or Oklahoma or these places, and basically build out these basins. And so just got a really great opportunity early in my career to be in a role that I really enjoyed. And then also at the same time, be at a company that was the most active in the industry, and also a company that really empowered young people. I mean, I think that, Aubrey McClendon, the late Aubrey McClendon, had this, motto basically where if you were fit to do the job, he would put you in the position. And so, I was like a 24-year-old, 25-year-old young professional getting to do things that I really probably had no business doing, just in terms of responsibility. And that really set us up to do what we do today. And so in 2014, I had left Chesapeake and was doing some consulting, and then ended up partnering up with my old vice president, who's 30 years my senior. And we founded Ancova, and it was really not doing a whole lot different than what we did at a big company, except we took those services and started to provide those to a lot of small and mid-sized guys that just didn't have what we did in-house. And so it started as consulting, turned into the physical marketing business. In 2018, we raised $200 million in private equity capital to go build pipelines. And that's a whole story. I don't know if it was good or bad timing. I think a little of both, but wound that entity down in 21, I think. But anyways, the company's relatively small. We've got about 15 people, and that's kind of the background on the energy side, and can dive into more here in a little bit if you'd like.
So you talk about the gentleman that you partner with being 30 years your senior. How important do you think it is for younger professionals to have, for lack of a better way of saying it, sort of a godfather figure that can help them either transition to other companies or bring them to a bigger situation? Because I have a few friends that have maybe somewhat similar trajectories in terms of their career path, and they do have that commonality. Some experienced older person kind of takes them under the wing.
It's huge. I mean, I think having mentors in general. I think I've put out a tweet before. It's probably one of the more underrated aspects of being successful in business is to have the people that can champion you and that can be there for you and provide their wisdom. I mean, there's just some things that you can't really learn unless you live them. And so it's critical. And, we joked around early on. It was kind of like an old doctor and a new doctor, young doctor start a practice type of relationship. He's really turned into, almost like a father figure over the years. I mean, we've, gotten into it a lot because I'm young and it's like, go, go, go. And he's kind of like pump the brakes, but there's like this good yin and yang to that relationship. But I think beyond that, from having success in business, what it helped a lot with was obviously the credibility aspect, basically saying early on in a company, it's really hard because you may have the best answer or you can provide the service for a better cost. But it's like, why should we use you guys? Like, I don't want to take a risk to use a company that's brand new. And so I think that having that, older, wiser person that's been around for a long time, that has a reputation, it was huge for us. And I think I'll joke and be like, I rode your coattails on this thing. And then he'll joke and be like, no, I'm riding your coattails because you pushed me to go. And it's like, I just think that it's a very good dynamic. And so I've always told people that and I'm also just a big fan of partners in general. Like I've said often, like I don't want to be the CEO of anything. I would much rather be a partner, because when you have good partners, it can be an incredible form of leverage. And yes, it's a headache sometimes. And yes, it's like a relationship like anything else. But I think people get caught up in wanting to be like the founder or this like CEO or wanting to be the guy. And over the years, I've learned that I don't want to be the guy. I'd rather be one of the guys or one of the people that can work together and build something. And I just think that there's a ton of leverage with great partners. So it's been huge.
But I think also part of what you're saying, based on your experience and what you do, is you may not want to be the guy in that sense, but you do want to be the Renaissance guy, right? Because you do so many different things, and I like to try to think of myself in a similar way. We'll touch on that, but I want to go back a little bit to, again, the consulting side from the energy and oil space. Have the needs of these smaller energy oil producers, have they changed at all? Is there more focus on certain parts of the business than not compared to history?
Yeah, there's been a lot of change. So, I joke when we first started, oil was 80 something bucks. I was just married, didn't have any kids, and it was like, all right, let's start this business. And then in like 6 months, oil was $30 and I had a kid on the way and I was highly stressed time of my life. But what we got lucky with, and a lot of businesses' luck, is that there was just this massive wave of private equity investments that was coming into the space. And so, my partner, he's got all these, his name's Mark, we call him Mark-isms. But he would say, can't swing a dead cat without hitting a new team that just got funded with a couple $100 million to go drill oil and gas wells. And so there was this great chart that I saw, and it was like showing the amount of teams that were funded with private equity capital starting in like 2012. And it was like 100 something, and then like 200, and then 300 something. This is annually. And then like, I think it peaked in like 14 or 15, and there was like 400 something teams getting funded. And each one of these teams is getting, typically hundreds of millions of dollars of funding, sometimes tens of millions. And then it started to decline. It was like back to 100 something teams. And then it was like 2019, it really fell off. And then 2020, it was like 0 teams getting funded, maybe like 1 or something. And then last year, last 2 years, very few teams getting funded. And so just less private money coming into the space. And so for us, that was a lot of our bread and butter clients, and still are our bread and butter clients. And I think that the other thing that's changed, and so that's been a challenge, continuing to grow. Like we've had success maintaining the critical mass that we have, but trying to grow in an environment where there's a lot of consolidation has been tough. But then ultimately too, what these people are trying to do, like, early on it was the drill and flip model. So it's like you lease up a bunch of acreage, drill some wells, and then you say, okay, we're going to show that there's this really aggressive spacing. And what that means is that we drilled 1 well here, but now we can drill 10 or whatever, 20 if you're in the Permian, or some huge number within a single unit. And so you basically prove it up, and then you turn around and you sell it to a strategic buyer or a larger buyer. And so there was a lot of that happening, and that model worked. I mean, I had a lot of friends and colleagues that had just created fantastic amounts of wealth with that model. And it really shifted to where, it's been brutal. I mean, prices are higher now, but from 14 through 2020, it was just a lot of getting beat up, multiple kind of downturns where we thought, okay, oil is going to break away from $60 or $70. and then it would crater back down. And so you had guys that had a lot of success in the early part of last decade with this kind of build and flip model. And then it became, okay, like there's really no buyers, or the price that they wanted to sell, they couldn't get it. And so I remember in like 2015 or 2016, a lot of these small operators, they were all coming to us, dozens of them being like, we're going to sell next year. And it's like, okay, well, you all are saying that you're going to sell. Like, who are the buyers going to be? And it turns out most of them did not sell. Now, there's been a few guys, like one of our very first clients, he's had like the Midas touch. He sold 3 unicorns in the last 8 years or something like that. Each one of his companies has sold for over $1 billion. He's just crushed it. But he's the outlier. Most of these guys have struggled to find a way to exit. And many of them today find themselves in a place where they basically have to drill their way out of what the situation that they're in. So they basically have to return cash through the drill bit, which is a much harder and more difficult model than just being able to sell the rumor, right? Like, you actually have to perform, the results have to come in, commodity prices have to cooperate. And so we are seeing activity on that front. That's been good. So, the churn is all right. Like, when clients sell an asset, sometimes you can pick up the buyer and that becomes a client. You can help them with their sales. But right now we got a lot of guys that have assets. They've decided to develop those assets. So that's the upstream side. The midstream side, the infrastructure, there was a lot of new areas that were kind of step out areas in these plays. And so you needed a lot of new pipelines, compression, processing plants. And there was a gold rush there as well. And I mentioned we raised $200 million. We weren't even looking for capital. And that's how easy it was to raise money there for a while, because the midstream space had the same dynamic where you could build out a system and then you could turn around and you could flip it. And so we could talk about what's happening in midstream if you like, but that dynamic's changed as well. It's just very hard to exit, and guys are just kind of in these assets for longer, which basically means they have to perform ton of consolidation. All those teams that got funded have now been rolled up. A lot of them are rolled up into like a couple teams. So a basin might have had, Oklahoma, we do a lot of work there. That's where I'm based out of. And there may have been a couple hundred teams, and now there's like a couple dozen, right? So it's like basically a lot of these portfolio or these private equity firms, smash code is what we called it, smash code these companies together. And then now it's like, instead of 5 companies funded by NCAP, there's like 1 company funded by NCAP or whoever, right? Pick one of the guys. And so the consolidation has been happening, and I'll kind of leave it at there. Hopefully that answers your question, but a lot of topics we could dive into.
Yeah, no, and you can tell my style is I listen and then try to branch off of different things that are being said. So you use the term prices cooperating, right? So talk about the sort of differences in thinking about price versus volatility of price when you were consulting with these, smaller, mid-sized type of companies. I mean, obviously, to your point, there's going to be a sort of an aspect of length of time, right, for a lot of these to be profitable. But let's face it, volatility is often what gets at least the hot money in when it's on your side, but it's not necessarily what creates value creation.
Definitely. Well, the volatility doesn't help from exiting these assets standpoint, right? Like, just in the last year, the amount of volatility, even to the upside, is not always positive, right? Like, what does that do to the bid ask? It's like, if you, especially like, you had some guys that were really natural gas weighted. And so it's like, gas goes from $3 to $4, everybody's excited. It goes from 4 to 5. You're like, oh my God, this is great, because it's been kind of languishing at, whatever, $2, $3 for the last decade. And then it spikes up to like $8 or $9. And, at that point, M&A, it hurts it really bad, right? It kind of grinds to a halt. It's like, well, what price deck are we going to use? And like, how much are we going to get paid? And then you start to look at the multiples, and they're really low, because it's like, well, I can pay you for the forward strip that gives you this high gas price for the next 12 months or whatever it is. But after that, it goes, I'm going to ding that pretty hard. We're going to risk it. And so these guys look at it and they're like, well, I'm only getting, this multiple on my cash flow. This isn't that attractive. But the volatility makes it very hard to forecast in these divestiture and acquisition models, like what you're going to pay for these assets. And so that it's not super helpful. I think, honestly, like a range bound price, I think, can actually facilitate a lot more deals getting done, because people feel like they can underwrite things a lot better. What we try to tell guys to focus on is the stuff that they can control. So like, a lot of what our company does is it's like, look, I can't tell you what's going to happen in the macro. I can't tell you what's going to happen even in basin pricing. I mean, a good example is like in Oklahoma right now, pricing is pretty strong. It's driven off of like the Chicago markets and some of these more regional areas and what the weather is going to be like for natural gas. Oil is pretty well tied to WTI, but for example, in January, the first of the month pricing was like $2 in basin above Henry Hub. So it's like Henry Hub was like 470 and Mid-Continent was like $6 something bucks. And so it's like, I can't control that. But what we can control is the plan that we put in place for the infrastructure, the deducts that you're getting charged. It's like, are you getting, these gathering fees or these fuel charges, like all this stuff. So we're really like more close to the wellhead. It's like, let's put the best commercial strategy in place to maximize, all the variables that we can control and to give you the flexibility to operate the asset in the way that you want to operate it. And I know that for those that are listening that are thinking more from like an equity standpoint, and then maybe they're amateur investors, but like these are important questions to ask and to look at when you look at public companies as well. It's like, what's their takeaway? I mean, look at the Permian right now, and there's a lot of gas that could get backed up. I mean, there could be a lot of flaring, there could be shut-ins. And so understanding what their infrastructure plan is, like how are they going to move the product, that ultimately is going to impact the price that they receive, their net realized price. Those are the variables they can control. And so volatility aside, that's what we try to help our clients focus on is like, look, I can't predict wars in Ukraine, but I can predict if you do this deal with this, infrastructure provider, these are the types of fees you're going to get. This is the type of takeaway you're going to have. This is the type of capacity you're going to be able to get access to. And we know with a reasonable assurity that you can move your product and you can operate your business. And so that's kind of where we try to play, because to your point, volatility is out there and it's tough to make. It's a tough business, to be honest.
Yeah, and all throughout FinTwit last year, the focus was on energy, rightly so, right? Did obviously very well, certainly relative to everything else. Was the only, you can argue, true bull market in a very challenging year for everything else. How's the private equity side look when it comes to the oil and gas space? I mean, you're closer to it than a lot of people because you're dealing with non-public companies. Are you seeing a tremendous amount of flow going on? Is it early? Is it maybe a warning sign? Just talk through that for a bit.
The private equity side is slow still. I mean, you've had a couple of the bigger guys like the NCAPs or NGPs or some of these other large upstream private equity firms that traditionally have been able to raise, and say traditionally, the last, call it, during the shale revolution, so the last 10, 15 years, they could go out and they could raise, fund 7 or whatever the number is, and it's like a $6 billion fund. And they go out and they say, we're going to start raising this fund. And it takes them however many months, and then they've got a bunch of commitments, and then they close it within a year or whatever. And it was a pretty like rinse repeat thing. And these guys were crushing it. I mean, they're getting 1% to 2%. Probably if it's that big, they're probably getting around 1%, but they're getting these incredible management fees. And that has slowed way down. There are very few new funds getting raised. There's been a couple guys, like I mentioned, some of the big ones that have either announced, or you hear people that work there talking about how they're in the process of raising some new funds. But we'll see. I don't think they're going to be as big as they once were. A lot of these guys too, when you talk to the private equity space during COVID, and they were just lost because everybody, number one, nothing was really working in 2020, at least early 2020 when prices collapsed. And so they had a lot of, markdowns that they probably needed to do, but didn't want to do because they're private. And so they can kind of, game that a little bit. And so they're sitting on a bunch of stuff that probably needs to be written down. And then also they're getting just a ton of pressure from LPs and institutional capitals for the ESG and the green stuff. And so it's like all these guys kind of rushed, or not all of them, but a lot of them rushed to go do like an ESG fund or like a green energy fund or whatever you want to call it, renewable. I mean, they all kind of had these fancy marketing names. But then like and they had more success getting some of those funds raised, and then, transitioning and having a team that just focused on that. But then it's like, well, then what are you going to do with it? Right? Like, where are you going to deploy that? And when you talk to them, there's like a lot of like, oh, we love carbon capture and we love all these different things. Like, a lot of them rushed into like the electric car charging stations and things like that. And it's like, when you really get the guy over a beer and talk to him though, it's kind of like, well, does this stuff make money? Like, where are the opportunities at? And it got really crowded there. And I guess the best way to put it is there was a big disconnect between what the LPs wanted, like the endowments of the world, these colleges, these retirement plans, like what these people wanted, and then what was actionable that made money, that actually could get a return. And so it's like, you got to remember when there's a teacher's pension plan, there's like teachers on the board of this large money manager. And so they're saying, they hear the sound bites, they hear what's in the news. and they're pushing these guys. It's like, oh, like everything's going to be powered by solar, so just go invest in that. And then you're looking at that space and you're like, this isn't generating the type of returns that we would need as a private equity to make money. So a lot of pressures there. And then now we saw last year with the bull market and, prices coming way back, you would think, okay, some of these people are going to come back in, the LPs are going to change their mind and say, oh, now we want to go back into these traditional resources. And I think there's been some that have, but from what I've heard, and I'm not as close to the guys that are raising the money, but some of these LPs are just out. Like some of these colleges, endowments, things like that, they're like, we're no longer doing fossil fuels. And so I think it's going to be a struggle for them. The guys that have assets today, they're in harvest mode. The good thing is that it prices where they are. A couple of things happen. One thing is that most guys that had a lot of production, they were hedged. And so when prices collapsed, they were able to cash out those hedge books. And it was a huge windfall for a lot of private equity groups. So that was good. And then prices came roaring back. And then they were able to take advantage of that. They probably hedged along the way as it came up, but they have wells. If they're a good company and they have a good portfolio, they have wells right now that are probably, highly economic to drill. And so as you drill new wells, that's a great way to get exposure to spot prices because you don't have those volumes hedged. And so they're bringing those online. There was a lot of consolidation. They're trying to cut G&A, like overhead costs. So they rolled a lot of these teams up together. And so now you kind of have like your best guys, like your all-star teams, and you're drilling. And so I do think that like the publics, and we can talk about it if you want, they're still somewhat subdued on what they can produce. And a lot of them are sticking to what they've said in terms of guidance. Like none of them are really stepping out and saying, you know what, actually, we're going to double the amount of rigs that we said we were going to do and, increase production a lot. Part of that is their valuations and what they're getting rewarded for. They're probably better off doing buybacks and things like that. But so the public guys are kind of sticking to the script, and these private guys, because of the lack of ability to exit, because of the lack of ability to raise new funds, they're like, all right, let's get after it. And you are seeing a lot of guys putting the drill bit to work, bringing production online. And if they have good rock, they're making really good money. I mean, I know some guys that really were able to ride it out, and now they have a drilling program and they're cash flowing like crazy. And so that's the dynamic. If you've got a good asset and you can produce it, that's great. This is a good time to be in that business, but still doesn't feel like a great time to be raising new money. It just hadn't come back yet.
So I think it's interesting, right? So from what I'm hearing from you, there's a real disconnect between the public and private side, right? So if the private equity is slow on the space, the public equity side has been actually pretty fast. I just did a quick look while you're chatting. And I know this is not really representative, but just as an example, if you looked at the XLK technology ETF last year in terms of AUM, it lost around 10 billion or so in assets, which is roughly the same amount that Energy XLE gained in assets from the start of 2022. So there's been a lot of, fast, you can maybe argue hot money in the public side, but it doesn't sound like the private side has the same dynamic. Do you get a sense that the valuations on the public side are maybe disconnected a bit from the private side or are overvalued? What are your thoughts there?
I think the public valuations are not, and I'm not like a public equities analyst, but from the guys that I talk to that look at this space, they're just not getting rewarded like they used to in the public equities for bringing on new growth and bringing on new production. So it's like, they used to be kind of growth driven, and that was how a lot of these management teams were compensated, and the stocks were kind of valued on like, hey, what's your growth forecast? Like, where are we going to be at? And now it's more like capital discipline, paying down debt. The balance sheets look a heck of a lot better than they have in a long time. A lot of these companies have paid off a bunch of their debt, and they now are kind of in, I said it earlier, harvest mode at the public side. But if you're a public, management team, you're looking at it and you're saying, all right, well, the analysts have said this is kind of what the investors want. They want this kind of slow, measured growth. They don't want a ton of new growth. And so we've got this like 5% or 10% growth target, which is, it's not much compared to what it used to be. And so there's that on that side. And then on the other side, it's like they don't want a surprise to the upside on CapEx. So they're very, conscious about that. But then when they do grow, they're not seeing that value rolling through the stock price. And so it's like, okay, well, how do we return value to the shareholders? And they're doing buybacks and things like that. And so I think that is driving. And then there's also like inventory concerns. You've got, like, let's just face it, when you have a downturn, these public companies drill their best rock, right? It's like, hey, things are terrible, prices are bad. Like, I can't go drill the stuff that's speculative. I can't go drill the step out wells. I got to drill my best wells. So you go through 8 years or whatever of a downturn, or 6, 7 years, whatever it was, and you're basically drilling your best inventory because you kind of have to, because you can't afford to drill a bad well when prices are soft. And so then prices come around, and now you run into an inventory problem. It's like, a lot of stuff works, but it's like if we run 10 rigs instead of 5 rigs, now we're in the inventory depletion, which then means you have to turn around and you have to add new inventory. And so I think that, like, basically what I'm describing is a lot of factors that I think will slow U.S. onshore growth from a production standpoint. And they're just not going to be in the same growth pattern that they've been in prior to this. And I think OPEC knows this. And so it's just interesting. On the private side, like I mentioned, you can kind of do what's best for that fund. And so if that fund doesn't have a great way to exit, and these wells are making great rate of return, which if it's in good rock, at these prices, they do make great rates of return, they're incentivized to drill because they want to return capital to, to the LPs. And if they can't do a big exit, then that's really their only mechanism to do so, is through the drill bit and to increase cash flow and do that. And so I think that the private guys have a better ability to grow. And then there's, like, outside of like traditional private equity, like these big funds, you've got like family office type money and private, like, wealthy individuals. And those guys can really take advantage of this environment because they don't have the constraints of like these LPs that care so much about the green stuff. They don't have the constraints of the public company, analysts. And they're just like, hey, they're a high net worth family. They've got some big ranch with they can drill a bunch of wells, or a lease on a giant ranch, something like that in Texas. And those guys, I think, have a lot of opportunity in these times because they just don't have all these other constraints. So if they have great rock, they can go get after it. So that's kind of how I would describe, like, the supply side in terms of the different dynamics between the different types of capital.
All right, so clearly you're a maxi on energy, oil, natural gas. I know you got a number of these, what you call side hustles, but others would call full-time jobs. I'm curious, and I've had similar people say things about the music and the app and all the stuff that I do. You have a real interest in Bitcoin, and as I understand it, you got involved pretty early. And I know you want to talk about sort of linking that to natural gas. I so happened to do a space just yesterday with a guy who founded a company called Gagliardi, which basically takes the natural gas flares and converts it to just a combustion engine, all that stuff, to turn it into mining, Bitcoin mining. A really fascinating business model. Yeah. Talk about, for the audience, first of all, just how you got interested, involved in Bitcoin, and how in the world you were able to kind of connect the two in terms of energy and the mining side.
For sure. Well, the Giga guys are great guys, and they've actually helped us, and I know those guys well. That basically, like, I described earlier, like, our job is effectively maximizing the value for the product sold. And, back in 2019, 2020, started hearing about guys mining Bitcoin using natural gas, and it was primarily with flared gas. So gas, for people that don't know, that doesn't have access to a market. And when Bitcoin went on its run, the netbacks, or the price received back at the wellhead, was just astronomically higher than what you could get for gas. So if gas was selling for, a gross price, call it, of $2.50, they were mining Bitcoin and getting the equivalent $2.50 per MMBTU, or MCF for people that think in volume. And, these guys were mining Bitcoin and getting like $35. All right. So it's like, and I hear about this, and this is somebody who spent their whole basically career focused on how do I maximize the value for product sales. And I'm like, this can't be real. Like, there's no way that you could get $30-something or whatever it was, $20-something some periods, depending on what the hash rate was and what the price of Bitcoin. I was like, there's no way that this can be real. And so just started going down that rabbit hole, started talking to some people in the space, do the energy podcast, and had some guys reach out and were like, hey, we would love to come on and talk about this. So made some relationships that way, started going to some of the Bitcoin conferences. And when I found out that the economics were real, started to figure all that side of it out. Then I was like, okay, well, now I have to understand Bitcoin, because if I am looking at this, and people were coming to us and asking us to consult for them, right? They're these Bitcoin miners, and they're like, hey, we want to find natural gas. We want to find cheap natural gas that's stranded or flared or disadvantaged. And so we started consulting for them. But for me to then turn around and translate that to a traditional energy business, I had to understand Bitcoin. So that's when I went like down the Bitcoin rabbit hole. And I have like kind of a libertarian bent to my politics anyways. I think of myself as a moderate, but typically more free markets, less government. And so a lot of the stuff in the Bitcoin world resonated with me, and just spent years basically reading and consuming as much as I could about it. Because look, it's like, if I'm going to be doing this or a proponent of this, I want to understand it. And so that's where I really became more convinced around the technology of Bitcoin and more than anything, the network. And so a lot of people, when I talk about Bitcoin, I really don't like to focus on the token because I think like 90 something percent of people, or the vast majority of people, focus on the token. They focus on like number go up and, all these things, the scam, you got to get more money in, or like, the people that bought early can cash out, like all these things. But so the token's one thing. What's really exciting to me though is the network, and seeing like this organic network that's really just capitalist driven, right? It's a bunch of people that are just going out on their own because of the, the invisible hand of the market, natural incentives, and they're building out this monetary network, and they're putting, these machines in place, and they're basically building this whole framework that there is no central body governing. And then you look at like all the things you can build on top of that, and then all the places in the world that really don't have a good way to send or receive or transmit value or store value. And you start to do the math and you're like, okay, well, there's this many people today that have access to money. And if, when I say access to money, like it's relative, right? I mean, if you think about like places like China and some of these big countries that are authoritarian, like, do they really have access to money? It's like, kind of like, sure, they can have a bank account, but like ultimately, it's owned by the state. And so if you look at the numbers, it's billions and billions of people that really don't have a good way to send and transmit value unless it's through either these authoritarian controlled entities like governments, or even in the Western world, like what we saw in Canada with the truckers and shutting off bank accounts and all that stuff. And so that's what gets me kind of bullish on the technology. I mean, the token is what it is. There's going to be a lot of speculation. You're going to have a lot of crazy things like the FTX deal and scammers and pump and dumps and all that stuff. But ultimately, the network is extremely resilient. It's a bunch of entrepreneurs and capitalists building it out. And the potential that it has to solve problems, I think, is really high. And so when people say there's like no value, there's no intrinsic value, I would point them to understanding the framework and the network that's being built. Because to me, that's what got me to buy in and be like, okay, this is a really powerful thing that could be disruptive.
Just the remaining minutes, everybody here, please make sure you follow Max Gagliardi, because even if you don't like energy, you don't like Bitcoin, you might like wine distilleries and things like that, which we'll talk about next. Let's go to our question.
It's a great question. It's tough. I mean, I think like when I started out, it was like, hey, I want to be an entrepreneur, and had that kind of mystique around it. It's like, forging your own path. And then over the years, that has afforded me the ability to have more freedom with my time. And so at first, it's like, it's all your time and that's all you're committing is to this one thing that you're trying to build. If you can have some success, that can then free up your time. You get, have things like good partners, the people that I work with, good employees, things like that. And so you start to build up leverage. And as that leverage builds up, that frees you up to do other things. And then it's like, all right, what do I want to pursue? And this is something I ask myself a lot. And so it's like, okay, you have all these different avenues, and it goes from being like, what can I pursue? What's the one thing I can find to do? And then it goes into, okay, there's all these different things. How do I prioritize it? And so I think that over the years, it's like I try to gravitate towards things that I enjoy. And so like the media stuff, a lot of people are like, why do you do the podcast? Why do you do these things? It's like, well, I get a lot of enjoyment having interesting conversations with people and a lot of fulfillment out of that. I also, it forces me to network and put myself out there. And I really wasn't on social media or doing any of this stuff a couple of years ago. My Twitter's like 2 years old. I think I started it in January of 2020. And so before that, I was just kind of a lurker. And then during COVID, this happened to a lot of people. It was like understanding the power of the connectivity and putting yourself out there. And so I just got out of my comfort zone and started doing it. And then like some of the stuff that we're doing with like the Bitcoin stuff, that just was kind of naturally, it went in tandem with what I was already doing. And so that made sense. And then I also enjoyed it and thought that, I liked the aspects of what Bitcoin is doing. And some of the other stuff we do, like this distillery that we just opened, is more of an investment. So it's more passive for me, but it's fun. And it's another thing that can bring people together and have a good time. And then like the real estate stuff that we're involved with, again, it's like, let's build something that can create money and create value, but it's also something that I enjoy. Like, what we do is like vacation rental stuff. We have this gorgeous cabins, and we are building this development in just a beautiful, beautiful place in the outdoors. And it's like, that brings me, sparks joy or whatever, like that one lady says. Like, it gives me a happiness from that. And so I think moving forward, the question of like what I want to do, why I'm doing it, that's something I ask myself all the time. I mean, it's like, I've got 3 kids. I've got a lot going on at the house. And so it's always like trying to prioritize and figure out what's the best use of your time. And it's a struggle. Like, I don't have like the silver bullet for that. And it's a really hard question to answer. But I think the main thing is just like continuing to do, what you love to do and try to be successful in the ways that your talents allow you to do.
And I will say, I think, Max, it's interesting. People say that you work hard to free up time. I mean, money buys time, you can argue, but that doesn't mean that you're not using that time for other things. I think when you're an entrepreneur, you're ambitious, you want to do more than just your primary domain. You want, I always liken it to, you want to diversify by having as many lottery tickets as possible in life, right? You don't know which one's going to hit, but you want to kind of expose yourself to as many positive tales, right? Whether it's, in your case, the distillery, obviously your existing company, Bitcoin, all the other ventures that you're doing. So it's a mindset that I think is hard for a lot of people that aren't entrepreneurs to really fully get their own heads around.
Yeah, it is. And it's like, sometimes you got to do the stuff that's the base hits that pays the bills. And then other times you can think big and you can dream. And I think like one of my things is I've always been kind of a big picture person. And so that stuff is fun for me. And I think that then, using the relationships and the people stuff is to help build. And people are always like, well, how do you do all these things? And I'm like, I don't. And they're like, what do you mean? I'm like, I'm just a part of these things. Like, yes, I'm somebody who's marketing them and putting myself out there and saying, hey, here's what we have going on. But like behind all this stuff, there's a bunch of really talented people that I've been very fortunate to have in my life. And those are the people that, create just as much or more of the value. And so it's like part of it is building those relationships, having that dream and then chasing it and just, not being satisfied. I mean, to your point around as many lottery tickets as you can get, that can be a trap too. Right. And so it's like, I want to be putting myself out there and doing all the things that I know that we're capable of doing. But at the same time, it's like, there's a balance. Right. And so I don't have all the answers figured out. It's hard. You chase things and you go down a path, and there's ventures that we've had that haven't been successful. There's ones that have been really successful. Like the media stuff, I really haven't made a lot of money. So if you measured it off of success on that, that's one measure. But the relationships that I've created and the opportunities that has opened up, it's been a bunch. And so, you just do the best you can and you follow your passion, and hopefully those passions can lead to some money if that's your goal. And that's not everybody's goal, but we try to do things that are kind of at the intersection of like what I love to do and where there can be the ability to create value. A couple of things. Like the first thing is on the mining pools. What you have to realize is the switching costs are zero to switch a pool. So like, and to spool one up, I mean, I'm not on the technical side of it, but from what I can gather, it's not all that hard to do. So the reality is that I thought about this when I first got involved. I was like, but don't the mining pools make it really centralized? And then I had this aha moment and I was like, wait a second. The mining pools are actually like the most decentralizing force, because what it allows is for some guy to plug one of these in their house, right? And I used to have one in my garage. My wife made me take it out, but you can just like anybody basically can buy like an S9 or an older machine for relatively cheap, a few $100, plug it in their house and uphold the network, and they can go, put themselves on a pool. And so what it allows is, rather than only being able to mine where your hash rate is what you get, you can aggregate it through these mechanisms. And although those may seem centralized, what they do is they actually create just this astonishing amount of decentralization, because now anybody, anywhere in the world at any moment can uphold the network. And if they don't like the mining pool, or the mining pool is corrupted or whatever, within the matter of a few clicks of a mouse, you can be off that mining pool to somewhere else. Right. So it can change. The cost of changing are zero, basically. So I think the mining pools are actually really an amazing way to decentralize the network. In terms of like the cost of energy and commodities going up, the machines are, yes, the chips are expensive, but over time, I think there'll be more competition there. And, there's always going to be a base level cost to build those. If they become too expensive to build new machines, then they will likely get more scarce, which will mean that there will be less new machines to plug in, which means the hash rate will stall or shrink, which means the block reward price will go up. And therefore, the machines that we do have will be worth more because we already have them. And then you'll make more money that way. So there's just going to be this yin and yang where it balances over time. And then the cost of energy, I think the main thing is like, what's incredible is how much wasted energy there is in the world. I think like, I knew in the oil field that there was wasted energy, but even just on the grid, I mean, there are just vast amounts of wasted energy. And so what's going to happen, and what is happening and what has happened, is that Bitcoin miners gravitate towards the cheapest energy. And the cheapest energy is typically wasted energy. And there is always going to be wasted energy. It's out there and it's everywhere. And so they're kind of like energy pirates, like they're going to seek and destroy any efficiencies in the energy markets, and they will go towards those. And the guys that don't, that have a lot of expensive energy, they're not going to be around very long. And then the hash rate will drop, and guys that do have the inexpensive energy will pick that up. And then the public companies that have aggregated a lot of hash rate, I mean, these guys are struggling. And we're already seeing a lot of guys that are going bankrupt or are about to go bankrupt. And so, again, that's the invisible hand of the market correcting things, right? So I hear your points, but I don't think that it will lead. I think that it will continue to be decentralized. Is the short answer.
So I want to hit on the podcast for a bit, Max, here, because you said, well, it hasn't really been, maybe that successful, or not, you're not necessarily monetizing it. So I'd argue that actually in many ways, if you can own the audience, there's a lot you can do with it in the future, no matter what endeavor you're having, right? So, and this was really sort of the realization that I myself went through. So for a number of years, I was on CNBC and Bloomberg. For a number of years, I was one of MarketWatch.com's top writers. And, I realized over time that even though I was getting a lot of eyeballs on that, the reality is I couldn't do anything with it. So I'd be working, but not really being able to do much. So I actually think there's a lot of value to putting out free content, getting people to know you, to trust you, because the reality is at some point, hopefully you have something that's of value to them.
Yep, absolutely. No, it's huge. I mean, I'm still going through the process of trying to figure all this stuff out. And I think if the goal is to make money off of creating content, then that's going to be a harder thing to do. You're competing with a lot of people, and a lot of people that do make money off of content, they do it in kind of cheesy or slimy ways, right? They're selling some class to teach you how to get rich, when really if someone could teach how to get rich in a class, then that class then everybody would do it, right? So it's the main thing is the networking, the getting yourself out there, the power of connectivity, the evergreen aspect of the content, right? It's there forever and people can find that. And then the other thing that I found that was really interesting was I would meet somebody that I listened to their podcast, and I felt like I knew this person. I was like, I feel like I know you. And then I felt like I had a relationship with that person because I listened to their podcast all the time. And then it clicked for me. I was like, wow, that's really crazy. How powerful is that? I've never met this person. They don't know who I am. And I feel like I know this person. And so that's when I was like, okay, there's something to this in terms of putting yourself out there, putting thoughts and ideas out into the world. And then the last thing I'll say on it is if, there are ways to monetize, and it comes down to what value are you providing in the world, and how are you promoting that? So whether it be a new bourbon brand that we just launched that I think is incredible, and I can promote that. That's a really easy thing to promote. It's fun. And people, typically people that drink, they like bourbon and good spirits, and we do vodka and gin and other things as well. And so that's an obvious one. But things like the real estate stuff that we do, I created a little hype video for this new development that we're doing, and got this voice actor to do it. And it was just a bunch of drone footage that I shot myself. I put everything together, and I posted it, and it got I did all right. I got a few thousand views, and posted it to this Facebook group, which is in the community that the real estate is in. And it probably got 100 something views. I mean, it wasn't very many views, but of those 100 something views, 5 people reached out and they're like, hey, I want to buy a lot. And it was over $1 million in sales that we made in the span of a month. And I was like, holy cow, I've never had a video go viral and get 1 million views, but there's a way to generate $1 million in revenue off of one piece of content that only had a couple hundred views. So there is a ton of power in distribution, and there's a ton of power in putting your thoughts out into the world. And it's not just monetary, although there are ways to monetize it, especially if you have something that's valuable that you need to promote. I think that can be huge.
Yeah, and I mean, there's nothing wrong with that mentality, right? I mean, I go back to some people think that you put all this content out because you're trying to make money from sponsors. Okay, well, unless you're getting millions of views or somebody like Joe Rogan, that's really not going to happen. So you're putting a lot of time and effort in. You're trying to put out quality contents. Why shouldn't you be able to use it to at some point promote something that you hope again would add value to the listeners that you yourself are creating, right? I think that's kind of I almost feel like in today's world, if you're going to be an entrepreneur, you basically have to do things like that, content, just to not only get your name out there, but also to hopefully have an audience of buyers at some point.
Well, yeah, I mean, you get what you give out, right? So what you put out into the world, you get back. And I mean, that's philosophical, but it's true. It's if you're constantly giving all the time, giving knowledge, getting great guests on like you do, putting these conversations out into the world, that's giving to people, right? You're not really asking for anything in return. You're just giving. And when you give all the time, just the way the world works, you will get back. And whether that's getting people to listen or getting like, these like monetary things that come back, like it does come back to you. And then it gets to the thing, it's like, what I've always said is like, if it's a common saying, but it's basically like if a tree falls in the woods and nobody's there to hear it, does it really make a sound? And it's like, you can be the best energy marketer, like what we do, or you can be the best like real estate person, or you can be the best whatever traders, you have your funds and all the things you do. You can be the best at what you do, but if like nobody knows what you're doing and no one, is aware of it, like it doesn't really matter. And
what's the point? Right.
Yeah, like what's the point, right? So it's like you can have the coolest idea, the coolest product, or the coolest service ever, or be the best at it, but if you don't have a way to distribute that to people, then it's like you're not maximizing it. And like a lot of people, a guy that I've listened to a lot, like early on before I did the content, was like Naval. He talks about like using technology, and he's like really into the coding side of it. And he's like, learn to code, all this stuff. But then he's like, but if you can't do that, he's like, well, then media, right? Like anybody can like start a podcast. Anybody can start tweeting. Anybody can start putting out a newsletter. Like there's no barrier to entry there. And so when I really took a hard look at our businesses, I was like, we're not using technology how we should be. And so I just made a commitment. I was like, we have to use tech, and the media thing was huge. And I'm a creative as well. Like I know you play music. Like I played music growing up, and was always very into, doing things that were creative. And then as I got into the professional world, that part of me kind of died. Like I just had no outlet for that. And so I think that the media stuff also for me is a way to use that part of your brain and to be creative and I think that's important. And whether that's like somebody likes to draw or likes to write or likes to do whatever, like I think that everybody should try to find some kind of creative outlet. So for me, it's kind of twofold. It's like all the benefits I mentioned, but then also you get to create something. So it's been incredibly rewarding. But there are times where you're like, man, this is a grind. This is a lot. Like, what are we doing this for? But ultimately, I think it's a long-term compound interest thing, right? Like over time. And I think it's worth it.
No, I'm with you 100% on that. I mean, honestly, I enjoy doing these conversations. I don't overly prepare. I just more listen and try to ask questions, but it does activate that part of the brain, which is not sort of the repetitive aspect of what is a big part, like it or not, of the asset management industry, which is sales. You got to be on the phone, talk about markets, and try to get people interested in what you're doing. So it does help kind of keep your own sanity when you're doing that grind of the stuff you have to do, the kind of grunt work to build a business. Let's go back to.
Well, I can answer if you want, and you can, Michael, because you got a bigger following than I do. But yeah, that's part of it, right? And the initial thing is like the fear of like, oh, you're going to put something out there and someone's not going to like it. And you get over that pretty quick because the scroll is endless, right? And if someone likes it, then they'll hit like, or maybe they won't. They won't hit like. There's a lot of lurkers. It's probably like mostly lurkers. And if they don't like it, they'll just scroll past it. And so you kind of get over the hitting post thing pretty early, or you just don't do this. And then the other part of it is like the attacks and all that stuff. And I mean, there's just a lot of people that are, in my opinion, kind of unhappy, like disgruntled people, and they just have a lot of negativity. And I think when you put yourself out there, you come into contact with those people more. And so that's just a natural part of it. But like what I've told people is like doing this stuff, what I've found is that I found the people that love me and I found the people that hate me, and I found them really fast, like a lot faster than I would have ever found them, had I not done it. And I think that's a good thing, right? Because the people that love you, I'm so glad that I found those people, and the people that hate me, like they probably wouldn't have liked me anyways. And so good. Like I found out who you were too. And like now I have that categorized. In terms of like the dealing with the public stuff, I mean, it is scary. Like I try not to put a ton of personal stuff. I mean, obviously I have plenty of my life on display, but things like my family, things like that, I try not to put out there. I've had some, I obviously get a lot of crazies in the DMs because of the energy debate. People calling me a baby killer because I work in fossil fuels. I've had people threaten me. Like, I don't know how serious it was, but just stuff like that, and you just kind of like, all right, that's a little freaky, but block that person, right? And kind of move on. But I don't know, Michael, I'd love to hear your thoughts on it.
Yeah, I mean, I would share the same kind of argument of threats and all that stuff. Look, I mean, my response is always like, all right, if you're not going to try and fight back, no one's going to fight for you. If you're not going to promote yourself, no one's going to promote you. So you have to be willing to be vulnerable, I think, right? And I get that's not a very sort of good answer from a professionalism standpoint, right? It's like, all right, you're gonna come across as if you've been there before, and you've got to come across stoic and all this stuff. I mean, the reality is we're all human, okay? And certainly, just like you, Max, in your experience, when oil was at $30 and you're talking about being stressed and all this. Listen, I mean, last year was a brutal year because risk off his treasuries. You and I talked about that, many, many months ago before it got even worse, right? In the treasury drawdown. If I can build an audience that understands why the cycle is in favoring approach, then hopefully whenever the cycle favors the approach, that becomes a stickier audience and maybe even investors, right? So I think when you're an entrepreneur, Max, I think this may be a good place to end it. You have to have almost a Machiavellian mindset in a legal and compliant way, obviously, right? That the ends justify the means, and that means that you can be emotional and you can be loud, but you've got to keep at it so that eventually people start to listen.
No, it is. It's true. You have to. I mean, like, you're putting yourself out there by definition because, like, you're in the arena. And I know you've said this before too, but it's like you're in the arena, you're putting yourself out there. Like, what you're doing is, that's the nature of it, right? Like, if you just wanted to punch a clock and go somewhere, there's nothing wrong with that. It's just a different mindset. And so when you've already been doing it on the entrepreneurial front and you've already been riding the highs and the lows, I mean, and it's real, right? Like, if you gain a client or lose a client or something happens, it's like, this is material dollars. And then you have employees, and these are like dozens of people's families that are depending on what, like, these decisions that you're making. So, like, those are stressful, right? Like, someone calling you like a bad name on Twitter or saying something dumb, it's like, it's easier to handle that once you've had to deal with like a lot of the other stresses I think entrepreneurs have to go through. So maybe, it sets the framework to be able to thrive and to do this stuff. But, everybody is human, like you said. So it's still always a challenge sometimes, but I think that having that entrepreneur mindset, I think it helps a lot.
Everybody, again, please make sure you follow Max Gagliardi. Check out his podcasts as well as, where's the distillery? What's the location?
Yeah, it's in Oklahoma City. So it's in the historic Britain district, what it's called. We're going to get outside of Oklahoma at first, but just from a production standpoint, it'll take us probably this year to ramp up enough production. We'll probably go like Texas and some of the nearby states to start, but hopefully it becomes a nationwide brand at some point. It's been a great project. And yeah, if you want to check it out, it's woodworksdistilling.com. And if you're ever in Oklahoma City or Oklahoma, it should be on the shelves here across the state throughout the year. And then hopefully next year it's in Texas and some of these other states, and then hopefully beyond.
I will definitely hit you up when I'm in either of those areas. Thank you, everybody, for joining. Thank you, Max, for spending the hour with us, and everybody enjoy the rest of your day. Thanks, Max.